Let's talk about what Sir John might think about the markets. Well, Sir John had some core fundamental beliefs. The first is that he avoided countries trending towards socialism. One tool that we use at our company is the Heritage Foundation's Economic Freedom Rankings. They publish it every year. In 2012, the United States fell to 10th place. We have had deteriorating scores in the areas of corruption, financial freedom, and government spending. That's definitely something we keep our eye on, and that is a great tool. Number two is he favored nations with savers and enterprising citizens. In the United States, as of January, the savings rate had increased to 4%. He definitely would have been concerned with the debt in the United States, though, and obviously 4% doesn't compare to the high savings rates of some of the Asian nations. And he liked well-positioned competitive firms with growth and thought they were the best long-term holdings. Now, I don't know if you guys have read the Financial Chaos memo, but in 2005, one of the last memos Sir John ever penned, he sent to me, and it was called Financial Chaos. It is printed in full on the internet. All you have to do is Google Sir John Templeton Financial Chaos, but it's definitely worth reading. And the first line of that memo says, quite likely now, in June of 2005, the peak of prosperity is behind us. And the memo goes on to spell out the impending disaster in the financial markets. And it's dead on. I mean, he was right in so many areas. And he's also got some pretty crazy predictions in that memo. So I would encourage you to read it. But during that time period, he was spending a great deal of time thinking about who would manage his foundation's assets and where to put those assets for safekeeping. And to give you an idea of his long-term perspective, he would tell me, Lauren, I'm trying to figure out the best place to invest the foundation's assets over the next 200 years. That's how far he thought. And he had us research everything from property on the North Shore of South America to property in the Caribbean, property surrounding airports and hospitals, all sorts of different research projects. In the end, this is what he came back to, stocks. And this is the last paragraph of that memo. Not yet have I found any better method to prosper during the future financial chaos, which is likely to last many years, than to keep your net worth in shares of corporations that have proven to have the widest profit margins and the most rapidly increasing profits. Earning power is likely to continue to be valuable, especially if diversified among nations. And that's what we do at my company every day, is search the globe for these opportunities. If you want to know what our process is, very quickly, it resembles a lot of other value investing shops, but we start with a quantitative screening process. These are basic valuation screens, low P, low PEG, low price to book screens. Then we narrow that down. We focus on the bottom decile of that list. We ultimately run things through a discounted cash flow model under various scenarios. Then we'll perform fundamental analysis, talking to management, but more importantly, talking to competitors. And then lastly, we'll see if the stock deserves a place in our portfolio. Right now, somebody was asking me how the portfolio is positioned today. You know, we do have about 50% of our portfolio in the U.S., and that is left over from the financial crisis when we were buying large U.S. multinational companies that were trading at the largest discounts. These were the J&Js and Walmarts of the world. We were also buying a lot of stocks in the ag space tied to the growth of the emerging market consumer during the financial crisis. And that's the one trend I'll leave you with, is that if there's one thing in our portfolio that ties everything together, it is the growth of the emerging market consumer. We think when the world is obsessed with the U.S. and the European debt crisis and when the U.S. consumer will come back, that really investors are missing out on the largest opportunity in their life, and that is the growth of the emerging market consumer. And just to put it into perspective for you, okay, in the height of post-war prosperity in the United States, GDP per capita was growing at about 3% per year. And what that meant is that your standard of living would double roughly once every generation. And that matches exactly what I've been told my whole life. Work hard, go to college, get a good job, you can have a standard of living twice your parents. But in the emerging markets, the standard of living is doubling every 6 to 10 years. And this has a really profound effect on consumption habits. So initially in the financial crisis, we were focused on a lot of the protein producers, the idea that you have a little bit more disposable income, you eat a little better, add protein to your diet. If you need protein, you need grains, you need fertilizer, you need farm equipment. And we really made a lot of purchases based on that trend during the financial crisis. A lot of those stocks have recently hit our approximation of fair value. We look for 50% upside to our approximation of fair value before we employ capital. And right now, I'll say the portfolio is transitioning, but we're finding opportunities around the globe. And with that, I really appreciate you having me here, and I hope that you learned something from investing the Templeton way.